Bitcoin has officially entered a defensive regime. After months of range-bound trading, we've seen a structural deterioration in sentiment, with the fear and greed index plunging from 42 to 27 in just 1 week. But this isn't just about price action. Under the surface, we're seeing a demand vacuum where sell-side pressure is no longer being met by meaningful institutional absorption. Today, we're breaking down the 3 major pillars shifting the 2026 market: Fed policy, the ETF Exodus, and why some analysts think we've become a one-buyer market. The macro landscape fundamentally changed on May 22nd with the confirmation of Kevin Warsh as the new Federal Reserve Chair. Warsh inherits a nightmare: sticky inflation at 3 to 4% and structurally high bond yields. The market is calling his strategy hawkish easing. He wants to continue quantitative tightening to shrink the Fed's balance sheet while potentially offering selective rate cuts if productivity, driven by AI, accelerates. For Bitcoin, which thrives on free liquidity, this is a mixed bag. The era of aggressive money printing is over. We are now in a phase of controlled liquidity, which typically means higher volatility and more policy-driven consolidation. While the Fed shifts, institutional confidence is wavering. May has turned deep red for Bitcoin ETFs, suffering their worst weekly outflows since January, totaling a massive $1.26 billion in just 5 trading days. Even BlackRock's IBIT, the titan of the sector, saw nearly $445 million leave in a single day. Major allocators are de-risking as Bitcoin failed to reclaim its short-term holder cost basis of $94,500 and lost the true market mean of $80,200. Without this institutional bid, downside risk remains elevated, and any relief rallies are likely to be corrective rather than trend reversing. Technically, the battleground is currently centered around liquidity clusters at $78,000 and $76,500. Analysts like Michael van de Poppe warn that because we've broken the crucial support zone between $75,000 and $76,000, a crash to the $60,000 level, revisiting the 2026 low, is now a distinct possibility. If we can't grind back above $76,600, the argument for new highs evaporates. Keep an eye on the CME futures gaps above us at $79,000. These often act as magnets, but until we reclaim the 20-period EMA on the 12-hour chart, the bears remain in total control. Here is the real wild card. Is Bitcoin becoming a one-buyer market? While retail has disappeared and ETFs are bleeding, Michael Saylor's strategy is operating on an unprecedented scale. Year-to-date, Saylor's company has acquired over 171,000 BTC. To put that in perspective, that's nearly triple the amount produced by the entire global mining network in the same period. Skeptics argue the market is now dependent on a single buying machine. If Strategy's ability to raise capital falters, the one mechanism currently preventing a steeper fall could turn into a liquidation loop. So what's the play? Watch $78,500. A reclaim here is the first sign of trend repair. Watch $74,200. A break below this monthly low target $70,000 and eventually $60,000. The Fed factor. Monitor Kevin Warsh's first statements on QT intensity. In this regime, capital preservation is the priority. The structural trend is bearish, and while smart money on Bitfinex is building longs, the broader demand vacuum is real. Stay cautious. Day.